Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy LeBeau, also of Commodity Research Group, and we're here with another edition of Energy Markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive, Oil and Gas Training, for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is July 10th. Andy, it's been another month. How's it going?
It's going good, Jim. How are you doing?
I'm doing good, thanks. As I always say, there's a lot of stuff happened. Let's get right into this. Earlier this week and earlier this morning, we saw the release of the IEA and the EIA's monthly oil reports, and there was both reports. They said they misestimated demand, and it was a little higher in that second quarter than they thought. Why don't you give us a little rundown of what you saw coming out of those reports?
Well, I thought the IEA report was, I don't know if one can characterize it as neutral to bearish or neutral to bullish, depending on your point of view.
Or your position.
Yeah,
Yeah.
Could go up or could go down. But I thought that, what they did was that the second quarter, as you mentioned, was not as dire as what they had initially led us to believe. And as a result, they upgraded demand for second quarter by over 1 million barrels a day. I think it was 1.4 I think that was the number, and that made the rest of the year obviously a lot higher. They increased third and fourth quarter a little, and in 21, relative to 20, they lowered demand, but they still said that the 2021 demand is going to be 2 million barrels a day below where 2019 was. So still a long way to get to any type of growth in demand. Personally, I thought those numbers are still too high. The second quarter, I think you can make a case that it wasn't quite as bad as what the IEA is saying, but they still are pretty relatively optimistic for the second half of this year and into the first half. So, Jim, our numbers, the CRG numbers, are lower than where the IEA has by a pretty good amount. I mean, we're like 1 million barrels a day, at least lower than where the IEA is.
Well, million barrel revisions aren't what they used to be in this market. I mean, we're throwing million barrels around like it's nothing because it's these markets we've never seen before. They're very crazy. But I'm wondering if is it possible that you might be biased being in the U.S. and hearing news about, say, the Sun Belt, increasing cases, COVID cases, lockdowns, things like that, where the IEA maybe having more of a worldview and seeing that Asia's really the original COVID centers are actually doing quite well. Think about Italy, China, other Asia, and Europe is doing pretty good. I mean, do you think there's a bias there?
There could be somewhat of a bias, but you're still looking at three big consuming countries that are struggling. The U.S., Brazil, India too, are having issues, and certainly Latin America, South America. So it's not clear that we're going to. China demand has increased, but again, you look at where's the demand increased. At least product-wise, gasoline demand has been pretty robust. Relatively robust. Diesel globally is a really big issue. And jet, as the IEA mentioned, is going to be a continuing problem. So how are we going to get diesel going? Right, that's trade. That's going to be trade oriented, and I think we're a long way from rebuilding rebuilding these distribution chains and rebuilding the global economy. I mean, we know where I think the IMF, what was their number, down 5% this year
Yeah,
for
my
GDP.
yeah, I'm not sure what the latest number is. Something like that. Yeah.
Yeah, 4 to 5%,
Right.
with a long way to go. So yeah, I think there's definitely some bias, but there are still some serious global issues.
So, and I think I'm still in kindergarten because I learn more from looking at pictures than I do from reading stuff. And the IEA and the EIA have a beautiful, beautiful chart with their supply demand balances. I put it in our blog. But if you look at that thing, we've got, they're looking for draws going out to the end of 2021. And the IEA has bigger draws in Q4 this year than Q3. So you look at, especially the IEA, it's like, it's hard to get bearish on this market, or, I'm not gonna, I saw a headline said from minus 40 to plus 150 in terms of prices. I'm not going to go there, but just saying, is this what do you think is in the market? And I know it's kind of a crazy question given what's going
Yeah,
on.
that's a tough question. I do agree with the IEA and the EIA that we are going to see stock draws in the third and the fourth quarter, and that should, again, it's the extent of the stock draws, which is going to be on demand, and we'll talk about supply, obviously, but I think the IEA is somewhere in the 5 million barrel a day draw. We are closer to 3. But a draw is that's not bearish,
Right.
as you mentioned. It's not bearish. Unfortunately, it's drawing inventory from from a very high level. You look at the IEA numbers for the first half, and you could see in those same pictures what the builds were.
Yeah, that's right.
And I think the EIA was talking about 1.4 billion barrels being built in the first half. That's EIA. I don't think it was that much.
Yeah.
But nevertheless, you're drawing from a really high level. So I think it's not bearish. It's bullish, but how bullish, is it going to be? And I think that's what the market's trying to grapple with right now. And we'll talk about supply. Inventories are still clearly high, but they have, they're in better shape given if you look at the curves, right? If you look
Right.
at the curves, the TI curves and the Brent curves, they're certainly no longer big contango. They've flattened out. So, I guess that's indicative that stocks are beginning to, are drawing.
Right. And I think they point out that floating storage is coming down, and maybe that's why. Is the June build up in inventories in the U.S. what you were expecting? Can't remember what you were saying. I think.
Yeah,
Yeah.
that was pretty much as we expected. The again, distillates are at a 38-year high,
Right.
and that's like the big a major problem for the market. Gasoline is okay, it's long, crude is long, but the EIA has a big draw in crude for for the third quarter. Actually,
Right.
they have it's pretty interesting. They have a 50 million barrel draw from June to September, which that would be supportive.
Yeah. And what is that? That some of that's oil production going down,
Yeah,
demand
they have,
going up.
well, what they have runs, and this I disagree with too. They have runs going in June it was 13.8. In July they say it's going to be 14.8, and in August 15.5, and September 15.6. So you got a big jump up in runs, hence the draw. Crude runs. are we going to go that high with margin? Margins are not. They're improving, but relative to history, they're horrible.
Mm.
So I don't think those numbers are going to be right either. From the that's this from the EIA. I guess I'm
Yeah,
pretty skeptical this month.
well, yes, and let's you put out for CRG, you put out a monthly report on commodities, and you talked about the narrow range of
Right,
prices that oil
right.
is in, right? So it sounds to me like you are thinking we go down to the, I mean, bottom end of that range, or we break out on the downside. I mean,
I don't know if it's going to be a breakout. I'm a little bit bearish, but as you mentioned, Jim, with a stock draw coming ahead, as we
right,
know in the second half, inventories are going to draw. We think, it's hard to get really bearish.
right,
And I
right.
think, as you mentioned, we're in a narrow range. It's tough to make a big bet here.
It really is. Yeah, yeah.
And volumes, I guess, are, we could talk about, where we are in volumes, but the market is struggling here on the volume side.
Yeah, I look at the options volume, and for June, it traded around 97,000 lots a day, which is a little bit better than May, but that compares with a year to date of 145,000, and it's more than half of the 204,000 a day in March, right? So it's almost like the market stopped trading, and vols have come down from their crazy levels back in April, which I haven't really gone back to examine too closely. I still have a little PTSD from that period. It was like, we get six vol numbers up to like 600. I mean, what is going on here, right? But so we've gone, just an example. We're in the low 40s now for the front 2 months in implied vol, and the actual trading range, or the historical vol, realized vol, is around 35. So implied is about 7 over, and that's not a real stable relationship. I mean, they continually cross each other. But back on May 18th, the implied vol was around 64. Historical vol was like 136. So it was like 72 over, realized historical vol over implied. So, it just tells you that the trading ranges have gotten way low compared to where they were. Just look at a chart, and it's showing up with implied vol, but implied vol is still above its long-term average of around 33%. So I guess my question is, are we in some sort of an eye of a hurricane where we're going to come out and see, vol go up out of here, or you see us continuing along the way where this narrow range going forward?
Well, right now, I think you'd have to say that it's going to just continue into a range for a bit. Or there's a time to, would you place a really big bet here? No, it's a tough time to place a bet. Obviously, if this virus does get worse and there are, if there are more global lockdowns, that's a big change. If the economy can't begin to improve, that could be a change. And the supply side, there are some big numbers out there. Libya being which the IEA highlighted. Libya being a big one, going from like 0 to possibly 1 million barrels a day by the end of the year.
Right.
And the OPEC Plus, they're gonna increase production by 2 million barrels a day beginning August 1st, according to their deal. It looks like they're meeting on July 15th. How
Yeah.
is that going to? Are they all? They've been awesome on compliance, except for Iraq and Nigeria, and the Saudis threatened them with going for another price war. I don't know why they bring that up again, Jim.
Yeah.
Since that was so successful, and they last time they pulled that.
Well, I love the way the press they call them laggards now. When we got into the business, they were referred to as cheaters.
Yeah,
So we might
right.
have a much softer tone. But yeah, OPEC Plus seems like they're in lockdown, and how just like human beings, we're chomping at the bit to get out of the house and go somewhere. And once you stop the lockdown, it's for people. I think it's really hard to get them back in the houses.
Yeah,
And
yeah, I think
OPEC, I
that's
think it
true.
might be the same way. You add, 2 million barrels. You say 2 million barrels, and they might say, okay, you're free to produce. And but I
Well,
think
it's
a
not
lot
just OPEC; it's the Russians, where they
right.
have been
OPEC
one of the
plus.
huge surprises, I think, of the first half of the year, of the many Jim, right? The many big
Yes.
surprises, including the number one surprise of oil going negative. To me, was the Russians going down that quickly to 2 million barrels, down 2 million barrels a day, and staying there.
Yeah.
You talk about chomping at the bit. Well,
Yes.
we'll see where they come out.
And take us through U.S. oil production. Now we hear they're looking to increase again. What are you seeing? I mean, what are you seeing there?
That is a yeah, the EIA in the short-term energy outlook actually has, they had June production around 11 million barrels a day. They've got July up to 11.4 and August up to 11.3, September 11.2, and then October and D's right around 11.1. So, production's been cut earlier, has been cut from 12.7, 12.8 to 10 to 11. So we're down 1.7, and then they've got us kind of inching up. And next year, they basically threw their hands up and said production's going to be 11 million barrels a day every single month. So no, they did increase it in November and December, but I
Yeah.
think I don't know. It's tough. I mean, these are tough numbers, but it does look like, given where the market is back to the 40s, there've been announcements of production increases. I'm sorry. I think that they may be right on the third quarter. We may see a slight increase, and fourth quarter coming down. The big question is the increase going to be more or less than what the depletion from lower rig counts are,
Right.
and that's kind of a tricky, that's a tricky number. I think these numbers, though, Jim, are a little bit higher than what a lot of people were saying back in, when the world was ending in March and April.
Right.
So that I guess that's good, and we'll see what happens in the Bakken, where their
Yeah.
production. Oh man, they were cranking away. They were cranking it out at 1.4 million barrels a day. A big comeback last year and early this, and then it just went to pot. I mean, down. I think they were down under 1 million barrels a day in March and April on the way back up, before they got this court ruling from, was it the appellate court that made that ruling?
Yeah. I forget. I mean, I don't
Yeah,
know,
yeah.
but it's that's a 570,000 barrel day pipeline that's going to be out of commission, right?
Well, Energy Transfer is still taking nominations for August, so they're not. They were told to shut it down on August 5th, but that's getting appealed. So that's still, for now, it's still operating, and it's probably something around 500,000 barrels a day, give or take. Could be. I'm not exactly sure what the latest throughput is. That's a pretty big volume, and it's not going to be made up that quickly if the Dakota Access is shut down.
And if it is shut down, some of that oil gets out by truck and by rail, right? Is it?
Yeah,
It's what happens, right?
yeah. There'll be some. I think there's about 100,000 barrels a day of pipeline capacity in other pipelines, and maybe the trucks and rail can get another 300, maybe, probably less than that. So, it leaves like 200,000 barrels a day stranded. And that's all, that's all those are mid-continent barrels. The terminus on this is Flanagan, and then it's shipped elsewhere.
Amazing. I guess we saw in the news that Warren Buffett bought some pipelines, and it's becoming like real estate. They just don't make it anymore, right?
Yeah. Yeah, there was a natural gas pipeline that project that got scotched because the companies, the costs of fighting finding their opponents to build these pipelines had just ballooned.
Yeah, don't get me going. I live in New York.
Yeah, I know.
We have people who work really hard to keep the pipelines out, which is their prerogative. But the same people will complain when natural gas prices spike in the wintertime, which is kind of hard for me to don't get me going.
I know. Well, I think it's pretty basic that pipelines are the most efficient way of transport and probably the safest.
Right.
We all can remember that terrible tragedy in Quebec where I think 90 people were killed when a rail car,
Yeah.
what it was where a rail car exploded.
Right.
A rail car filled with crude.
Yes.
Exploded.
So you talked about product demand and margins. You think refiners? I mean, I guess I guess what I'm trying to get to is we used to think that a good way to hedge oil prices was to maybe, we always think about selling forward or buying puts or something like that for producers. But if you're an integrated oil company, perhaps a better way is focus on becoming a low-cost producer and keeping your balance sheet in good shape. So this virus has kind of blew that apart, where there seems to be existential risk in some of these companies going forward. So do you see? I guess what I'm getting to is, do you see a bright spot in the energy areas? Say, like, I guess I'm saying, would you rather be a owner of a refiner? Would you rather be a producer, a pipeline? What part of the upstream, downstream do you think is going to be doing better going forward?
That is an excellent question, Jim. And I think that, as we start working off these inventories, we certainly haven't, we start working off these inventories, margins are ultimately going to improve. However, what it's going to take for these margins to improve is rationalization on refinery capacity. And Europe is going to have to lose some refineries. So if you don't own those refineries in Europe, that have to go under. I mean, they have to because there's still increased refinery capacity coming out in big projects in Asia. So once these European refineries are mothballed, I think margins are going to be all right. On the midstream, again, that's going to probably take some higher production, which we know is U.S. production, which we think is going to come. Natural gas demand has to improve on the natural gas side for midstream, but that should that should improve. And upstream, we're clearly not making. We've canceled billions of dollars of projects. So one would think that upstream is going to we'll have its day in the sun again. It just may be maybe a couple of years hence. So I guess if I had to rank them, I'm not going to.
Well, there's also plastics out there, HGLs and things.
Well,
like
there is.
Yeah.
I mean, unfortunately, there's too much capacity right now.
Yeah.
There's too much capacity globally,
Right.
and certainly the overall world environment and the move towards sustainable production and the ESG movement and
Hmm.
everything else is not. I guess it's not particularly the move to electric vehicles. Also, not particularly that constructive for the petroleum industry, but the petroleum, for the fossil fuel industry. But I don't think we need to strike a death knell for it. I think there's still some good years ahead,
Right.
and the companies are preparing for it.
Yeah, they are. That's right. That's right. They're changing their logos.
Yeah, they're changing they're changing their focus.
Yeah, they
You
are.
look at some of these European companies. Total's been all over this, Shell's been all over it,
Yes.
Exxon, BP, they're all, they know what's coming.
They're moving that direction for
Yeah,
sure.
yeah, the majors are moving the right. Yeah, they're moving in that direction.
So Andy, I want to get a price range going forward. Your choice, WTI or Brent or both. What do you think?
I think for the month, it's still WTI is going to have a hard. There are a lot of headwinds. So do I think it could get back to the mid 40s? Yeah, on a reach it could. I prefer it under. I think more likely. I think in the 35 to 40 range than the 40 to 45 range. That's a big 45, 35 range. That's probably right. And for Brent, we could just add a couple of dollars there. Now here's the question, Jim. So we look at this range, right?
Yep.
And you've got vols higher than, implied vols higher than normal.
Yep.
Would
No.
you sell?
No. Listen, I trade markets not in a big way, but my favorite entry place when I'm talking as a really small speculator, is I like to buy options. And it's a lot of these markets, even though they've come somewhat back to normal, bid offer spreads are still kind of wide. I mean, I'm not talking so much about oil, but some of the other like metals and things like that. And but back to oil, if you have a trading range, you do want to be selling options, but listen, I it's not the way I like to approach a market as a speculator. That's been my view. I've had people come up to me over the years and say how much money I save them mainly from the Salatini, lose your weenie idea, but still, the idea is don't get too enamored. The other thing I'd say is we tend to get more comfortable selling vol once we see a narrow range show up on the charts. So we've seen a month or so of the market kind of moving upwards to sideways, and the range, as the range gets better defined. In my experience, it looks more comfortable to sell, and yet you're getting closer to that particular market becoming becoming a commodity, which means it'll move around more than you think. So that's just my view.
Well, for our listeners, the question I was about to
Oh,
ask,
sorry.
no, that's all right. I mean, he knows what the question was. Would you sell strangles here or sell vol? And he knew that's exactly where I was going with that. And I knew the answer as we've been working together for a long, long time. So I knew exactly where he was going. And I think that's great advice.
Yeah, never say never, but it's you don't want to make that the main sort of cornerstone of your trading portfolio. I don't think. I think it's just once you start doing that, you hear the time bomb ticking, and as we've seen it year in, year out. And my other pet peeve, Andy, is don't call it normal. And we're not going back to an old normal. We're not there because there was no normal. There's no new normal. There's no old normal. Stop it with the normal.
Yeah, we're not going to revert to the mean. whatever the mean is.
Yeah, the market will stay away from the mean as long as feel like it can go to the mean. And then once you feel it can't go to the mean, it'll go to the mean. So,
Oh, there's
yeah,
no question.
yeah,
Yeah,
it's
that's been
those,
proven over, as long as this thing's been trading,
yeah, yeah.
as
So
long as markets have been trading.
I'm sure there's people out there that are making money trading on mean reversion
Oh,
ideas.
sure.
I
Yeah,
just haven't met any of them.
yeah, me neither.
Okay, we don't want this to deteriorate into you know, a bull session. But anyway, anything else you want to add to this
No,
podcast?
I think along the lines of selling vol, there's still a lot as we head into I think it'll be range bound, but there's still a lot of hurdles to go, and things as we've learned, can change pretty rapidly. We'll see what OPEC Plus has for us on the 15th. I think that's going to be important, and then all the economic data that continues to come out, and whether Congress has another, whether there's still more out of Congress in terms
Which
of not only Congress, globally, whether there's more stimulus still to come. I think that's going to be important, and
more trillions?
yeah, whether we're going to see more trillions coming out of
Yeah,
U.S. and elsewhere,
right. Yeah, the whole
Uh,
world
yeah,
is
the whole
flush.
world. I think I was reading that total stimuli has been 15 trillion globally.
Yeah, that'll explain stock market, I guess.
Yeah, I guess, right.
Yeah, I think it's quite possible that in 2008 the Fed was pumping reserves into banks and they were just sitting there. And this time we're getting fiscal help putting money into bank accounts. So it's like in the hands of the people. So the checking accounts are showing huge increases. So both are stimulative, but this time it seems like it's more effective with people that it's in the hands of people that actually need it. Because you give money to a bank, they have to lend it out. If there's no one there, if everybody's scared, no one's going to take you up on a low interest rate. They're pushing on a string idea. If you put it into people's bank accounts who aren't working, they're gonna use it. And the problem is you need more trillions. And I looked at World War II. We're still not up to World War II yet in terms of percent of GDP in debt. We're heading in that direction. But if you kind of, I don't know, you kind of look at this thing as a war that we're in. Hopefully, next year at this time will be, you know, on the upside and not on the downside. So it's hard to feel that way when you're living through it. But
Right, right. Well,
you know,
that's the other thing, well, the progress on vaccines and treatments, is another key component.
yeah, I think we said in one of these podcasts that more important than supply demand numbers and economic numbers as oil is what Fauci was saying. Where are we in the development of vaccines and treatments? And I guess now like you said, the oil market, it's work. You can get an economic number that drives the oil market up and down. So it's got a little correlation to the stock market as well, which is we saw that big in 2008, 2009 as well. So what kind of indicator do you want to see first, Andy? What's your top indicator now for just to tell you about the oil market?
Well, for diesel, obviously any kind of manufacturing data and they have been pretty good.
Yeah.
It's coming in. It's coming in a lot higher, and the jobs number for gasoline is critical, obviously, because people don't have jobs, they can't drive to it, and can't spend, et cetera, et cetera. So I think
Right.
those are really big numbers. I think we'll see where miles traveled comes in as well, but that tends to be a lagging indicator. I'd say on manufacturing and trade for diesel and diesel, distillates, and we're in major oversupply. Although what's been surprising is that the curve has been tighter than what you would think. So tough to explain that one.
All right, let's wrap it up. Anything else, Andy?
Let's see. You can find our monthly report on the podcast on our website.
That's a great report. I read that because it's so succinct.
Thank you, Jim.
Yeah.
That is on commodityresearch.com, commodityresearchgroup.com. Sorry. And you could get a hold of us. You could just get a hold of me, Alebow, ALEBOW, at commodityresearchgroup.com, and I'll make sure that Jim gets any messages or questions you have on options.
Okay. Thanks, Andy. We'll talk to you next month.
All right. Thanks, Jim.